Welcome back. You're watching the 18 Money Show with me, Kavita Thaplial. And recent AMFI data showed a threefold rise in inflows in equity mutual funds. However, it was multi-asset funds that stole the show with the highest inflows in multi-cap funds in December. Today, we will discuss and analyze why multi-asset funds are gaining in popularity and whether you as an investor should look into investing in multi-asset funds going ahead. Let's bring on board Kirtan Shah, founder CEO, Credence Wealth Advisors. Kirtan, good evening and welcome to the show. I want to discuss the multi-asset funds and the kind of rising inflow in this, but then we have a caller online actually, and I don't want to make him wait, Kirtan. So let's start with our viewer queries first. I have Aditya from Bangalore online. Aditya, hi, good evening, and thank you so much for sending us your query. So the kind of corpus you want to accumulate is 5 crores for your retirement in 29 years. Is that right?
Hi. Yes, that's correct.
All right. Could you elaborate on your investment strategy right now? I can just see PPF. That's 1 lakh rupees per year you invest into, and NPS also.
Yes, ma'am. Actually, I'm investing around 1 lakh per year in PPF.
Yeah.
1 lakh per year in NPS.
Mm-hmm.
And 500 per month that will be on tax savers.
Okay. That is 4,500 per month.
Per month.
Yeah?
Right.
All right. So now do you want to increase your investment amount?
Actually, I'm planning to increase it by 10%.
Okay.
In the investment per year.
All right. 10% per year you can increase it now, right?
Yes. Yes.
Okay. And you have counted inflation also because you've come down to this corpus of 5 crores. That will be enough for you. You have calculated your post-retirement expense and your lifestyle. Has that all been factored in?
I'm not exactly sure, but
okay. Not
it
a
should
problem.
be in that ballpark.
Got it. Not a problem. We have Kirtan to help you out with that. So, Kirtan, 29 years and the corpus is 5 crores for retirement.
Hi Aditya. Aditya, if I do some very simple mathematics, wherein if I have to understand how much would you have to invest every month to be able to reach a corpus of 5 crore in 29 years, that simple mathematics would lead me to a 22,000 rupee a month requirement in terms of investment for you to be able to reach 5 crore rupees in 29 years. Now I'll tell you the challenge here, Aditya. While this math is done, assuming that you will be able to, kind of make 12% return on your investments, there is a small challenge in terms of the portfolio that I see that we are discussing on your behalf. So I see you're doing 1 lakh in PPF, 1 lakh in NPS, and another 4,500 a month in Quant. Now I'm assuming that you probably are doing this to kind of save tax. Now, there are two problems that I see in your portfolio here. First is the total investment that you are doing to save tax is roughly 2.5 lakhs, whereas the maximum on which you are able to save tax is only 2 lakhs. Now, what do I mean by that is that your ETC limit is only up to 1,50,000 rupees, right? So your 1 lakh of PPF and probably your 55 odd thousand of Quant, that is perfectly placed for you to get the 1,50,000 deduction on ETC. But the NPS investment that you are doing is only up to 50,000 rupees. I'm not sure why you're doing 1 lakh a month, right? So my first suggestion is probably you could reduce your NPS from 1 lakh a year to 50,000 a year. That's point one. Point two also is that the kind of returns that you probably will be able to make on the PPF to a larger extent is going to be much lower than the 12% at which I'm assuming while I'm doing this calculation. So largely in my opinion, if this is the context or this is the allocation that you are largely going to have, then even 22,000 rupees a month will not suffice, and you would have to do upwards of 35,000 rupees a month to be able to reach the goal that you are looking at, because on NPS and PPF, the kind of return that we will have to assume will be much lower than 12%. So two suggestions, if at all you are doing it for 29 years, I think keep a separate portfolio which focuses only on equity. where you're able to make 12% odd returns. And for that 12% odd returns, you might only want to do 22,000 a month. Second is you can reduce your NPS to 50,000. This is general and out of context of your question, but the additional 50,000 to NPS is not really giving you any advantage.
No, I think that really makes sense. But then Aditya, any more clarity you want from Kirtan?
No, ma'am, that's all. I will plan my entry and I plan to reduce my asset allocation.
All right. So I'm not able to hear you properly, but I'm assuming that you've understood the suggestion that's been given to you. And if at all you're not able to hear it properly, we have this show on our YouTube channel also. Maybe over there you can catch it. But let's move on to our topic of discussion today, which is Kirtan. The AMFI data reports that people are investing in multi-asset fund. Now the times which we are into right now, so much of volatility and economic slowdown globally that we are witnessing, multi-asset funds have come up as a star. Very right time, because we've seen a lot of AMCs launching back-to-back multi-asset funds also. Just to get a backgrounder of what kind of asset allocation does a multi-asset fund have?
So Kavita, largely if you go theoretically, multi-asset fund is expected to have at least 10% each in 3 asset classes, right? So those 3 asset classes can be anything between equity, fixed income, gold, or even real estate, right? So it is like a flexi cap fund that you have in equity, right? Where you give the fund manager the choice to decide where does she really want to invest in equities. Similarly here, what you are typically doing is when you invest money in a multi-cap fund, you're ideally telling the fund manager that you decide which asset class you are bullish on and you take your bets accordingly. Whereas SEBI only says that you need 10% in 3 asset classes. So you might always see 10% in equity, 10% in fixed income, and probably let's say 10% in gold. The remaining 70% can be in any of these assets, right? So you might have somebody who's doing a very equity heavy multi-cap fund and somebody who's running a very fixed income heavy multi-asset fund. So largely this is what multi-asset fund does.
All right. So currently, what kind of funds do we have in the market? If you could just elaborate on that. And because there's equity component, debt component, a lot of them have commodities also. So there are 3 fund managers involved in one fund?
So typically what happens is, largely Kavita, is that today also if you look at what's happening, and we've been tracking these funds for quite some time, the problem is that you will typically see most of these funds have a very large equity exposure at all point in times, right? So theoretically, while SEBI allows you to switch between, fixed income and equity and commodities as much as you want, but typically what happens is largely most of these guys would have at least a 50% or a 60% exposure, typically always kept to equities. Even if you look at this point in time, while you and I are discussing, largely everybody has upwards of 50% allocation to equity. So it is easier to assume that theoretically you are betting on this fund, assuming that if the fund manager feels gold is supposed to do well, they will have a very high allocation to gold. Or if the fund manager feels that fixed income is supposed to do well, they might have very high allocation to fixed income. But largely the way to look at this fund is 50-60% is largely always invested in equity, and the remaining is moved in another 2 or 3 asset classes, depending on where probably there is a tactical bet that the fund manager sees. And also in most of these funds, they don't have 2-3 fund managers. They will still largely have one fund manager, but because they have a couple of analysts working on this particular scheme, it is more interchangeable, and you don't really need 3 fund managers managing one fund. So it's largely one fund manager. Theoretically, largely allocation of 50-60% to equity, and the remaining is maneuvered around commodity, fixed income, and real estate.
Tell me one thing now, Kirtan. Now, on a portfolio level, you're already diversified, like say just for example, and then if you have a multi-asset fund, are you not over diversified?
Very honestly, Kavita, I don't think multi-asset fund really solves any purpose in that sense, at least the way I look at it. Because like you rightly said, that while you are investing in a mutual fund, right, mutual fund will have thousands and lakhs of investors who are investing, right? So at the fund managerial level, the fund manager cannot manage your asset allocation as an individual investor. What the fund manager's mandate is when you invest in a multi-asset fund is to be able to understand at the macro level whether equity is supposed to do well, fixed income is supposed to do well, gold is supposed to do well, or real estate is supposed to do well. And then give larger allocation to that asset class so that at the fund level, you are probably able to do better risk adjusted return. But if the investor is assuming that if I will invest in this fund and my asset allocation will be taken care of, that's a very wrong strategy. Also, unlike all the other funds where there is a very defined strategy, this has a plus, at least in my opinion, is that the equity side of the investment does not have any market cap bias, right? So the fund manager, like in FlexiCap, is free to invest wherever she wants. On the fixed income side, it does not have a bias. And today also you have some funds which have very low duration and some funds which are running high duration in the same space. So that definitely gives a lot of flexibility to the fund manager in that sense, but it definitely, in my opinion, cannot take care of asset allocation at the client's level. So it's a very tactical investment where the investor does not understand what will work in 2023. So they are assuming that let me give money to the multi-asset fund manager and let him or her decide which asset will do well and allocate monies accordingly.
Reason of rising inflow in this category then, Kirtan?
I think that's the prime reason why a lot of money has flown in. Because look, what is happening, Kavita, at this point in time is, the equity markets are quite volatile, right? And a lot of us assume that probably at these market levels, equity is fairly priced. So is there too much of a scope where there is a lot of undervaluation in equity? Probably the answer is no. If you look at gold also, gold last year gave 11.5% returns, right, in rupee term. This year, of course, you are expecting gold to do well in dollar term, but if rupee appreciates, you might not see gold performing that well in Indian rupee context. Rates are also topping out. So there's too much happening in each of these asset classes, right? And probably at the retail investor level, it is going to be very difficult for them to be able to understand that which asset class will perform tactically for, let's say, 2023. And hence, the mutual fund industry is probably, using this as a platform saying, give us the money and let the fund manager at his or her level decide what allocation will make sense in 2023. And hence, a lot of money is flowing in this category, in my opinion.
Last question, and then I will move to Rashid, who's there on phone line with us. What is the tax treatment for multi-asset fund? Because you've got an equity component, a debt component involved in it. So how are they treated as?
So largely, what we have to understand is that when the fund has more than 65% allocation given to equities, is only when you can treat this as an equity fund, right? But if you look at historical data points and the way most of these funds are positioned today, none of these funds have that level of equity component, and hence these funds are taxed at debt level. What that means is for 3 years, up to 3 years of investments, any gains that you make will be taxed at your slab rates. And over 3 years, whatever gains that you've made will be given the indexation advantage, whereas you are only expected to pay 20% on the gains, taking the indexation benefits into consideration.
Got it. So that's all for multi-asset fund. And quickly let's move on to our next viewer, who is Rashid from Pune. Rashid, hi, good evening. Thank you so much for sending us your query. And I can see you have Franklin India Blue Chip, HDFC FlexiCap, Kotak Emerging Equity, and SBI Focused Equity in your fund. You're also investing in Sukanya Samriddhi Yojana. Is that all, Rashid?
Yeah, that's all. Yeah, thank you for taking my question. Yeah.
Rashid, also I want to understand, Okay, 50 lakhs is your corpus for your daughter's education after 12 years, and you are going to increase your investment amount by 10% every year, right?
Yeah, correct.
So
And
this,
one more to
sure.
add on this. Actually, I want to increase the amount by 2,000 rupees more monthly SIP. So my question was, should I continue with investing or increasing amount in the same fund, or whether should I add another fund or new fund in my portfolio?
All right. Since how long are you invested in this portfolio and in this fund?
Okay, so in this particular portfolio, I am investing from last 1 year.
Okay. And did you go to a professional financial planner, or you just did your own research and got these funds?
Yeah, so actually I watched your show, and on basis of that and listening to your guest, I decided to go with this portfolio.
All right. Thank you so much for watching us. But then a lot of times what happens is we give suggestions. The kind of suggestions and fund recommendations we give are very case specific. So Kirtan will dissect and tell you if the funds that you've selected are right for you or not. Kirtan.
Hey Rashid, what I understand is that probably at this point in time, you are looking at accumulating 50 lakhs probably over the next 12 years. Now look, I understand, and I'm so happy that you know this concept of step-up SIP, where probably every year you are okay increasing your SIP with increase in income. So I've done some basic math which tells me that if you start in total with a 12,000 rupee of SIP today, and then step it up by 10% each year, then you will be able to reach 50 lakhs in the next 12 years. So 12,000 is the figure that you need to invest today. And then a 10% SIP will make sure that you have 50 lakhs at the end of the 12th year for the goal that you're looking at. Now, this is assumed that we'll be able to generate 12% returns on your portfolio. Now, Rashid, on your portfolio, I have two suggestions. First, because I don't know your risk profile, but I see that your existing portfolio is 70-80% focused only on large cap. So theoretically, you might feel that you've taken one blue chip, one focused, one flexi, but you see all of these three funds are largely focusing on large cap. So let's assume that you don't really have a very high risk appetite, and you have enough risk appetite to invest in equity on the large cap space. Then this allocation is okay, but because of a lot of overlap, I would suggest you to reshuffle a couple of schemes. So you can exit the Franklin India blue chip, you can exit HDFC flexi cap, and replace that by a PPFAS flexi cap and a Canara Robeco flexi cap. But let's say because you have 12 years to go and you are okay, you've understood investing might have a little bit of volatility, then I would suggest that you can probably add one more mid-cap fund. Let's say an Axis mid-cap fund will be a good combination because you largely have value investing schemes. You might add this growth investing scheme, and probably your portfolio might do better over a period of time. So that's my suggestion, Rashid.
Anything you want to ask, Kirtan?
No, that's all. That's answered very well by the guest. So thank you for answering. Yeah.
Thank you so much and all the best. We move on, Kirtan. We have Lavisha's question for you, and she wants to understand if she can invest in a balance advantage fund. So what she says is investing in a balance advantage fund, is it better than investing in a large cap or a flexi cap? And she has ICICI Pru Balance Advantage Fund, and she wants to know if she can hold on to this for a very long time. Although we don't have the other details in terms of portfolio, she's just asked this question for a balance advantage fund.
So, Loisha, I won't confuse you, but I have a very straightforward answer to this. Please understand that a large cap, flexi cap funds are funds which are 100% equity, right? And a balance advantage fund is a fund which will keep moving the equity allocation lower and higher depending on the market situation, right? So there can be times where in a balance advantage fund, your equity allocation may be as low as 40-50%. And then there may be times where your allocation is 80%. Now, if you theoretically ask me, I would say an 80% equity portfolio and a 20% fixed income portfolio will do much better on a risk-adjusted basis versus a 100% equity portfolio. But in a balance advantage fund, you don't have 80% and 20% fixed. So it can be 40% and 60% also, and 30 and 70 also, right? So in that context, I would say if you have a long-term horizon, let's say 10 years, your flexi cap fund, in my opinion, should be able to do much better than the other two categories that you figured out. Look, large cap fund, at least since 2018, when SEBI came up with the categorization rule, I don't think they've really been able to do anything great because their hands are tied with respect to a lot of regulation that SEBI has. So my opinion is if you have 10 years of investment horizon, a flexi cap fund is better than a balance advantage and a large cap.
All right, we move on to our last query, and that is from Mr. R.S. Chandra, invested 50,000 and 65,000 lump sum in SBI small cap and HDFC flexi cap, Kirtan, and he will invest another 40 to 50,000 when the market crashes. Now, how is this the strategy of investment right or wrong according to him? I mean, what would you suggest? He's trying to time the market.
Mr. Chandra, largely look, buying the dips is a brilliant strategy. And I just wish that every investor probably learns something out of you and they know that if the market falls, you end up buying. But I'll tell you a big problem with buying the dip as a strategy is you are trying to time the market. Largely because I don't know your background and I don't want to contemplate, I'm making a very general comment that it's very difficult to actually buy the dip than theoretically saying that I'll buy the dip, right? Is because when the market is at 100 and it falls to probably, let's say 95. Now you're not sure whether it will go down to 90, 80, 85. And typically we've seen people that when 100 becomes 95, they still wait because they anticipate that it will come down to 90 and 85. And in that anticipation, they don't end up investing at 95. And suddenly instead of markets coming down, it goes up and they lose out on the buying opportunity, right? Now, if that's the case with you, which I think is the case with 90% retail investors, I would rather suggest that you don't try and time the market because you will often not be able to time it correct and you will miss out on the opportunity. So for somebody who's a retail investor and not a very professional investor, I think investing it through an SIP or an STP mode, right? Investing that money in fixed income and then doing an STP every week into your equity fund is a far superior strategy, is because it takes away the element of surprise where you probably might go wrong in trying to time the market, but it only with a disciplined, kind of invest the money irrespective of where the markets are going. So I would rather suggest that use the STP mode to deploy money in the markets rather than trying to time the market, because theoretically you might want to buy it at lower prices, but practically it's slightly difficult to be able to execute that strategy.
Systematic way of investment is the way one should obviously adopt. And thank you so much. With that, it's a wrap, Kirtan, on the show today. Thank you so much for being on the show and helping our viewers with their finances and financial goals. And before I sign